Hi there, just read this disclaimer please. Alright everybody, how's it going? So, as promised, it's just gone past the 6th of October, which is the date that I do my official yearly kind of summary in my unitisation spreadsheet for the performance of my portfolio. So I'm going to take you through that and tell you what's been happening and what might happen in the future with my investments. So first of all, I'm going to just show you how I've done from the 6th of October to the 6th of October 21. So here's my unitisation spreadsheet, and as you can see, the return since the 6th of October has been 24.52%. And as I showed you last time, I've been comparing it to the Life Strategy 100 fund here. So if we go to this chart here, that's kind of shows you the charts since I started unitising my portfolio. And I'm still heavily behind the green line, obviously, which is kind of to be expected since I've done so badly up to here. And then here's a chart of how I've done from the 20th of October to the 25th of October. And as you can see, as before, I'm still beating the Life Strategy Fund, but I think it's probably come in a bit. I think since the 30th of June when I did my last video, it seems like the green line has definitely got a bit closer. Or more accurately, the blue line has dropped closer to the green line. All of this yearly information that's in here, I've kind of copied across into this yearly summary spreadsheet. And it shows here, so I've just got the information about the yearly performance was 4.52. And if we come down here, I've got the kind of yearly summary of how I've performed versus the Life Strategy 100 fund. And as you can see, I've only beaten it by 2.87% here, which is nothing compared to the 3 years prior, where I got heavily destroyed by it. But as I've always said, I'm kind of not hindered, but kind of, I don't know, it's to be expected in these times of growth stocks doing better overall, the past 10 years at least. For me, living off my portfolio in retirement, it's a bit difficult mentally for me to have a portfolio full of growth stocks which are currently in favour. Who knows, they might be in favour for the rest of my life, who knows. So it's a bit difficult to do that, so it's kind of to be expected in these times that I will lag the market, even if I have the odd year like this where I've done better. So anyway, I always say that in every video, just so that everyone has the perspective on why I'm not so focused on beating the global market so much. And I think probably if I was in my accumulation phase, I probably would go for, maybe not the Life Strategy 100, maybe the VWRL, the worldwide tracker. The total performance of my portfolio is 24.52%. And then if you just look at the income unit, so this is the performance when you strip out the dividends that I've paid myself, or that have been paid into the portfolio. So it's made 21.01%. And then along with that is an income of that much per income unit, 0.2836, blah blah blah. And as you can see here, my income has increased by 1.32% per unit. So that is the portfolio on its own without any inflows or outflows of capital. Because as you can see here, last year I actually added 3,150 to the portfolio, whereas previous years I'd taken money out. Well, actually no, done nothing that year. I took four grand out that year, and I've added back in 3 grand this year. So that's why I have two different measurements of my income growth. Per unit, it grew by 1.32, so that's kind of organic growth, how the portfolio's dividend increased just on its own. Whereas this other measure of income here, which is the actual pound amount of income I took from the portfolio, that was paid by the portfolio, sorry, actually increased by 1.65%, which makes sense because the 3 grand that got added to the portfolio here is obviously going to create an income. Well, unless I invest it in something that has a 0 yield, but that's not what happened. That's why that number, 1.65% increase in income, is different from this number, 1.32%. And I think that's why it's important to measure this, because that's how the portfolio is done on its own back. This is how well the portfolio is done on its own back, plus my addition of capital. So that really is not, if I'm measuring my performance, that's not the number to look at, that's the number to look at. But if I'm just thinking about my life and how I'm going to do, that is kind of important, because that's my new level of income now, isn't it? It's two different ways of looking at the income growth, which, depending on what kind of frame of mind you're in, both can be relevant. And then what I normally do here is I put in how much I've spent, but obviously my spending budget spreadsheet goes to the 3rd of November, so that info is not there yet. I can guarantee it's going to be below 10 grand though this year, so there's probably going to be a surplus here, which is just the difference between my spends and my income plus my LISA bonus. So my LISA bonus gets added there, because in effect I spend that LISA bonus of 1 grand each year. So yeah, hopefully, so this might mean that when I go and look at my bank accounts and add up all of the money that's in them, it might mean that this coming year I might be adding some more money to the portfolio. I do that at the beginning of each calendar year, so the 2nd of January that year, 2nd of January that year I took some out. So 2nd of January this year I might well be adding probably a couple of grand maybe, I don't know. I'll have to check my bank accounts and keep that 6 grand buffer, I think is what I normally go for. 2 years worth of not pulling any capital out of the portfolio in a worst case scenario, you know. I've just copied the spreadsheet and kind of collated all this info. I haven't bothered. I tried to do it for the momentum ones. It was just too much effort. It would have been trawling through too much data to find it, and Woodford I can't be bothered with either because it's such a small amount. I've kind of written off this money, to be honest. I've kind of written it off as zero, even though it's in there at a grand and a bit. So as you can see, let's have a look. So 24% overall, so the outperformance, Lowland and Merchants. I'll talk about that in a minute. Smaller companies have done really well this year as well. Scottish Mortgage continues to do really well. Not quite as well as the year before though, obviously. That was a bumper year. Song's a bit of a plodder, Hypnosis. And the biotech growth thing that I went into was a bit of a badly timed moment to get into that investment trust. But you know, it's there for the long term. I don't mind volatility. And Worldwide Healthcare, I mean, these have only been a couple of months, maybe a bit longer, I don't know. IEM's done well this year, but obviously I only bought in partway through the year, so you can't really look at that and attribute it to my 24% performance. BlackRock has done quite well, and obviously now the reason I've put this second column here is because 8th of Feb 2020 was roughly the pre-COVID peak. So I just wanted to put into perspective. So when you see 80, 87 and 102, you think these are magnificent investments. You might think that if you were naive. But I wanted to show this column because actually that gives you the reality. These have only done so well in the past 12 months because they did so badly just prior to that. So if you look at the pre-COVID peak to now, or to yesterday, they're not that great, are they? They're pretty bad. Down 10%, up 10%, up 5%. It's the same with when you're comparing these three UK income trusts, you know, similar remits. You might think that Merchants and Lowland are the best ones by far. But actually, I mean, they are better than City of London from the pre-COVID top to now, but they're not massively better. They're not 20 odd % better, are they? They're a few % better and 15% better. So yeah, Merchants has done really well actually, hasn't it? But it was one of the laggards in the COVID dip. Not dip, it was like what was the word I'm looking for? Bear market. Like 30-40% down. But Merchants was even worse down. So sometimes that can happen. Sometimes you have to go with a volatile stock because even though the lows are really low, it can sometimes long term be better for you because it recovers even more. It's kind of the opposite of how Funsmith tends to perform. Funsmith is a very good performer, but it's also very smooth in how it goes up. It doesn't have massive drawbacks, as you can see there. Bit of a laggard in the past 12 months, but over the whole period it's 25%. Trades since the last video. What have I done since the last video? I've highlighted it here. Right, I got out of Lintel Train Global Equity. To be honest, I'm kind of losing a bit of faith in Lintel Train in general. And I got into Brunner. I liked the performance of Brunner when I looked at it on the AIC's website. It seemed a bit more forward focused to like technology and stuff. I don't know, kind of Finsbury started to feel a bit old fashioned, and it has a handful of holdings in Finsbury Income and Growth that I'm not that keen on. Like, it has Hargreaves Lansdowne, which I think overcharge, and I think at some point the customers might start to realise how much they're getting overcharged. Man United, and I think Celtic, I'm not sure. Football clubs basically are in there. They're not in the top 10, but they are in there somewhere. And I just think football clubs, any profit they make historically has just gone straight to higher player wages. What was the other ones that I wasn't so keen on? Can't quite remember. I don't know, I'm just kind of losing faith in them a bit. And Brunner seems to run at a nice discount, although to be fair, if you look at the 10-year discount on it, it's always had a big discount, so the chances of that discount actually benefiting me if I ever wanted to sell are quite slim, because it seems like it's just a perpetual 10% at least discount, apart from here where it's spiked up. I don't know, I just like the performance. It's got a better performance than Finsbury over 10 years, and a better performance over 5 years and a similar performance over 10 years. So you could say this is the moment where Finsbury might make a comeback compared to Brunner. So what I'm doing is, it's the Brunner BUT is actually in my LISA. So I'll go here where you could see more information. It's in my LISA. So what I'm going to do is, I'm just going to, each year, it's going to be a very gradual process. Each year I'm going to use my LISA £5,000 allowance, £4,000 of my own cash, £1,000 of bonus. I'm going to use it to take Finsbury and move it into Brunner. And luckily Finsbury is outside of an ISA. So that's something I need to sell and get wrapped in an ISA anyway. So it's kind of, it's not wasting trading fees, because that Finsbury is always going to get put into an ISA and sold at some point. So it's a gradual process. I haven't completely and 100% lost faith in Finsbury, but I think gradually I'm going to move away. These are just the usual momentum trades. And as usual, I sold a bit of Scottish Mortgage. I'm always selling Scottish Mortgage, and it tends to be a mistake. And I bought a bit more of JP Morgan smaller companies. It was at about £3,000, and it was kind of like a position that's like such a low percentage of the portfolio. It's like, what's the point in having it? So I wanted to boost it. I've also upped my smaller companies target percentage. So I've got a £6,000 deficit there on smaller companies, which are these three. So I just sold a bit of Scottish Mortgage, put it into JP Morgan smaller companies. These are just more, these are my half-yearly momentum fund switches. And then I had £2,500 in the portfolio, and I bought more Murray International. I just wanted to boost my income a bit, you know, and at the time, and I think probably still now, because it was very recent, wasn't it? What date was it? It was 6 days ago. Yeah, a nice 6% discount there, getting a nice 5% yield. And if you look at the 10-year premium and discount, different to Brunner, it's not at a perpetual discount, is it? It tends to hover around the 0% and look even higher in these early 2010s. So that discount could well come in, who knows. So I'm pretty much down to 0 cash now, 30 quid cash. So I've not really much options if there's a big pullback like yesterday and the day before. But I'm just fully invested really. Okay, so I'm here just looking at the last video you guys saw. So as you can see, since the last video on the 1st of July, my expected income then was 10 grand and 31p, £31. My expected income now is 10 grand and £383. So that's good progress. I mean, I think a lot of it is that Royal Dutch Shell, Barclays and NatWest have all kind of got back to paying bigger dividends. They've what have we got here? 52, 97, 52 and 41, 141, 157 and 83. Obviously buying Murray International with a couple, 2.5 grand, that boosted my dividends as well. But apart from that, I think it's just kind of really incremental small increases to the investment trusts dividends each year. And I thought I might as well just show you how 2021's gone for those. So in really bad times. So obviously here I also bring up RPI, CPI, and the UK rent index that I found on a government website, because I always want to track because I don't want to own homes anymore. I've owned a few homes in the past and I don't like it. I like the freedom, I like the lack of responsibility. So I just want to track that I'm not losing my spending power when it comes to renting a flat or something. And as you can see there, the numbers. I mean, I don't know how relevant they are to me, because any inflation kind of measurement, it's just a guess, isn't it? Because each individual person's spending is different, so you never know. I mean, I would only want to rent a 1-bedroom flat because I'm a single guy. So who knows whether two bedroom, 3-bedroom houses are higher weighted in these indexes, and actually, even though it says 1.29% there, it could be that 1-bedroom flats have gone up by 5%, couldn't it? You never know. But it's better than nothing. It's something there to track, just to keep an eye on for me. So as you can see, City of London, just an incremental 0.5% increase in 2021. This data is a bit skewed because they've all got different year-end dates. You can see some are June, some are December, September. So it all is a bit skewed, but it's the best data I've got. 0.5% up. Haven't got the full year's worth of FTSE 100 and the FTSE 250 yet, but as you can see, they had a massive drop. Both of them did, and they're already coming back really strongly. You can see there. See, that's only got 3 of the 4 dividends, and it's already higher than last year's. And similar story with the FTSE 200 tracker, already higher than last year's, with 1 quarter's dividend to come. Haven't got the data there yet for Lowland, but 0.84% the year before, because it's a later year end, isn't it? BlackRock smaller, 4% and 2.5% over the past 2 bad years. Finsbury, they held their dividend static for 2020, and they're back now to growing it by 3% for this year. HFL, they had a decent increase, 2.68% last year, and they're on track. I mean, you can pretty much guarantee that's going to be a 5.9p at the end. So if we fill it in there, 1.74% increase coming for this year. We're international, 12.85, but yeah, 2% last year. So it all makes sense. Oh, well, that's quite a high one, isn't it, for 2020? But yeah, so far they're flat. I think it's because when the pandemic started, they'd already kind of set the stall out at setting their quarterly dividend at 1.5p. So they didn't, even if the yearly total was going to be an increase, it looked bad if they went and chose the last one to be lower, or the last 2 to be lower. So I don't think Hint would have ideally wanted to increase the dividend by 5% that year, but they kind of boxed themselves into a corner, and they've just continued with 1.5p for the next 3. I imagine this one will just be the next one will just be a small amount higher, I would guess. Merchants, very low increase, as to be expected with all of them really. Why would any of them increase their dividend by a lot in these years? But it's nice that they have increased it. It keeps my income nice and smooth. Oh, some trades that I'm considering. At some point, I think I might sell Shell. It might be soon. You know, if Shell keeps on this run it's going on with the high gas prices, high oil prices, I feel like it can't go on forever. Maybe the moment might be, just psychologically, when this number goes to zero, when I'm not at a loss on the capital value. Maybe I'll sell that and buy more of Hypnosis, because at the moment it's yielding higher Hypnosises than Shell. I mean, that would take me overweight Hypnosis though, so I'd have to put a bit into Hint or something like that, so that I don't go overweight Hypnosis. Hint's 1,700 grand below target anyway. So that's one thing I'm considering, possibly. And also, I have a few grand of the Barclays holding is separate from the rest of it. It's outside of an ISA. So at some point, looking at that yield of 1.55%, I'm considering possibly putting a few grand of the Barclays, which yields 1.55%, into this trust, which yields about 1.57. So at a nice discount. It's well, it's always at a nice discount by the looks of it. So similar to the Brunner one there, but it's got a pretty good long-term performance, and it's European smaller companies basically. So it would help get this underweight position of smaller companies back to equilibrium without adding diversity. I've already got Asia, America, and the UK covered for smaller companies. It would be nice to have Europe covered as well, a little bit. Yeah, I've probably explained before, I want a big exposure to smaller companies, and that's my favourite, BlackRock smaller companies. But I feel like I don't want the percentage in any one trust to be too high. So that's why I diversified into these two. And then this might be a little bit more diversification into Europe with the smaller companies. Anyway, they're the couple of things that I've got on my mind that might happen at some point. I mean, I'm really too active, you know. I really think I'd be better off if I just never did anything. Scottish Mortgage would have made me way more money if I hadn't kept selling and selling and selling it. And I'm still doing it today. I know these behavioural things that I do are not in my best interest, but I can't stop doing them. I can't stop fiddling. I don't know. Maybe one day if I got all of these numbers down to a reasonable amount, like that one was closer, that one was closer, maybe that would help me stop, but I don't know. I think it's just in my nature. I think that's all I've got to tell you about. It's a long video, so who knows, maybe this might even turn into 2 videos, you never know, or 3, I don't know. Anyway, I'll see you next time. Bye bye.